information presented in this presentation is believed to be factual and up to date as of the date noted. It should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Okay, we are going to introduce our panel. We're going to start with Dan Obrist. Dan, in 2024, earned the Chartered Financial Analysis designation and joined John G. Ullman and Associates, an equity research analyst. In the current role, he conducts bottom-up fundamental research on publicly listed equities for potential inclusion in client portfolios. Dan is a member of the John G. Ullman and Associates Investment Committee. I should have read these before. Some big words in here. Okay, good. All right. Next up, we're going to introduce Andrew Barron. Andrew is coordinating investment with tax optimization. Andrew is always looking for new ways to assist clients in establishing a strong financial foundation. He achieves this through objective guidance and hands-on implementation with other professionals to ensure the client's best interest is always the premier focus. He is also the host of the hit podcast, Well, It Depends. And finally, we'll introduce Jason Nickerson. Jason is the president and chief operating officer of John G. Ullman and Associates and a member of the John G. Ullman and Associates advisor team. He holds the Certified Financial Planner designation and is an IRS enrolled agent. Thank you for joining us.
Thank you, Frank.
We're going to ask Jason, if you don't mind, could you kick off our Big Beautiful podcast maybe with just an overview of the Big Beautiful Bill?
Sure, we can do that. So as we all know, we jokingly named this event after the name of the bill itself, the One Big Beautiful Act, One Big Beautiful Bill Act. So if you hear us refer to it as OBA, that's short for instead of saying all of those words all at once. And what's interesting, very non-political, I think it's the worst name for a bill that we ever managed to name something. Andrew was just saying his favorite one was the Secure Act a few years ago. One word, easy to say, but we're here anyway. And as a matter of fact, USA Today published an article a week or two ago that the president's starting to walk back the name of it. It was a good name to get it passed, but it's probably too big to kind of keep it going because it's a lot of words. It's a mouthful. The bill was signed into law July 4th. Obviously, it's very ceremonial relative to the date. And when I started reading the bill, I estimated that probably 80% of it is something that's already in place today. So with all of the fanfare that comes from passing this bill, we're already living, in my opinion, in the world that was created back in 2017 and 2018. And I would say that it breaks down into really three areas. I would say that there's an extension and permanency piece to this, okay, of what we're already living. There's an extension and permanency piece that has some adjustments to it. And then there's some new stuff, and we're going to cover some of that today or this evening. And then there's I think some controversial things that we'll kind of get into and talk about that are in the background that aren't specific to individual taxes relative to increasing the nation's debt, Medicaid, Medicare cuts, and rollback of some climate initiatives. But I mean, that's kind of what we're facing. The name, as much as I joke about it, it is a massive bill, whether you like it or not, and there's a lot tucked into it.
Well, and maybe we should start with the debt. I know that's been a major topic. Maybe you could elaborate on that, what that means, and kind of clear through some of the confusion that we hear on TV.
Yeah. So one of the pieces of the bill authorizes an increase to our nation's debt limit. It increases it by $5 trillion up to $41 trillion is our new debt limit. Anyone who wants to dig into data, and I have dug into a little bit of this, and not totally verified, but round figures, we have seen and been on quite a trend of debt increases over a number of years. As advisors and people who are charged with helping people manage debt decisions appropriately, we think that this is a dangerous path for the country overall. And that's, again, nonpartisan, non-political based. But if you just look back in history and start looking at debt increases going all the way back to Bill Clinton, most would say Bill Clinton was the most fiscally conservative of the group from that point forward. He did create budget surpluses, and he only increased our debt in total over his 8 years by 1.4 trillion. It only went up from there. Bush was 5.85 trillion over his 8-year period. Obama, 8.34 trillion. Trump during his first administration, over 8 trillion. And then Biden in his 4 years was roughly 6 to 7 trillion. And so it doesn't matter. It's not a party-driven comment when I say that, trying to manage the nation's debt and fiscal situation is really, really important. And, what we've done is tuck another debt limit increase into a bill. And, these are unpopular decisions when we do this, right? They don't win votes to decrease the nation's debt, to try to create budget surpluses and so on. But the fact of the matter is, this is theoretically going to create more debt, and it takes that decision and puts it into a bill versus making it in the forefront of a decision making somewhere down the line.
Isn't that kind of the nature of some of these big bills?
Yeah.
I mean, when you have that many documents, it's going to add up. But I want to get into kind of some of the nitty gritty of it, because we know that Trump's tax cuts and things that were discussed a lot. So we've heard it called kind of the sequel to the Tax Cuts and Jobs Act of 2017. Is that a fair statement? How does that actually relate to what we're seeing in the big, beautiful bill?
So I'm going to disagree with Jason on this. Jason has a number of years on me, and maybe just smarter than me, but I had to put considerable effort into updating what I know about this new tax code. I tell my clients, so I'm the branch manager of the Rhinebeck office in the Hudson Valley, so I have a lot of clients in the Hudson Valley and New York City. So I have a number of clients where itemized deductions, because high property taxes is suddenly a big deal, that we didn't have that ability to itemize when we were talking in January and April. We do today. The other big one is senior clients, so people over 65. We have an extra bonus deduction. Once again, this is a planning technique I didn't have available to me a few months ago that now I'm sitting down talking to people about. And third one is tips and overtime workers. Similarly, people who are hourly, extra benefit that I didn't have in January, that it makes sense to at least sit down. It may not move the needle, but I think it's worth a review.
And you had mentioned, Jason, that this was signed into law July 4th. So when you talk about like tax on tips and some of these major things we've all heard about, when are these actually going to go into effect?
Well, a number of them phase in this year.
Okay.
A number of them phase in 2026, which kind of makes it fun to be a financial planner. But most of the big key things that the headline things are effective in 2025. So the increased standard deduction for seniors is effective in 2025. The increased itemized deduction, so SALT, so we used to only be able to do 10,000 for a couple, we can go up to 40,000. And where I am, 5-digit property taxes is pretty common.
Right.
And then finally, the overtime and tips is effective in 2025 as well.
Okay. And you mentioned SALT, and I know that was a big sticking point at one point in the discussion. Does this mean people will see bigger refunds or lower taxes because of that fight over the SALT deductions? Explain that to me.
So a lot of people get confused about the difference between a tax credit and a tax deduction.
Sure.
Tax credit is dollar for dollar, here you go, you get money back. Deduction is just going to reduce your taxable income.
Okay.
So I work with a lot of couples, and I know this number's a little bit better. Under the former law, a couple could take $30,000 off their income to reduce it, we call it AGI, adjusted gross income, and then we would tax that amount.
Okay.
If we itemize, we could exceed that potentially. We used to only be able to take $10,000 for state and local taxes, that's what SALT, the acronym stands for. But now we can do $40,000. And like I said, where I am, $20,000 in property taxes is not uncommon. Mm-hmm. So this lets people who were previously capped 10 to take the full 20.
So people have been taking the standard deduction since 2018. How does this change that? What will that change now?
So I actually looked into the statistics that as of last year, only about 10% of Americans itemized, and this will push it up to 15%. But it is concentrated in states like New York, Massachusetts, California, and where we have a lot of clients, especially locally.
Well, and I would say too, Andrew, when you look historically at how this came about, the idea was we're going to try to make the federal income tax simpler, and it really didn't, because as you referenced, in the state of New York, while you may not be able to itemize your federal return, you could still itemize on your New York State return. So it was just as difficult. It was just as complex, because now you still had to do the accounting. You're only getting benefit on one side. And hopefully that opens up a little bit more. Is one of the more controversial points was the SALT tax deduction, and I think we're getting a little bit of relief there, certainly.
We received some questions from people ahead of time, and I thought we could maybe get to some of those to somewhat kick off this event. This coming from someone in the audience. I'm especially interested in any implications for international holdings.
I'll take that one.
Sure.
Yeah, so I think, I'd say for the past 1 to 2 years, there's been a lot of talk as valuations in the U.S. have kind of climbed and climbed. What does that mean? What does that mean for, international holdings, holdings that aren't exactly subject to the same forces, variables that we see in the U.S.? I think that narrative, is going to continue. Like Jason has been talking about, some of these features in the bill are kind of backloaded. So we see a lot of the cost savings coming on the backside, where a lot of the spending increases on the front. I think that will create a lot of stimulus for the U.S. economy over the first few years of the bill. What that means on the back half of the bill is kind of yet to be seen, and how we deal with the deficit. So I think a lot of that deficit just gets pushed down the road further. So I think for now, international holdings probably take a back seat, but I think going forward, there's probably an increased spotlight for them.
Yeah, relative to the taxes on that too. So if people do have holdings outside the U.S., nothing has really changed relative to the reporting. And I personally feel it. I deal with a few international clients where the reporting has only become more. So no changes to if you file an FBAR or FATCA. There's still a foreign earned income exclusion. There's a foreign tax credit. U.S. citizens are taxed on worldwide income. So if you do have foreign holdings, in this bill, there was no relief of reporting or essentially taxes, especially if you're a U.S. citizen.
Another viewer wrote in, or audience member, said, personally, what effect does this have on Medicare and Social Security? And two, more broadly, what effect on the economy overall?
Well, so there's some confusion about how this affects Social Security. Mm-hmm. It was originally sold that there would be no tax on Social Security. Yeah. And instead there's this, they're calling a senior bonus deduction. Okay. Although it's even more complicated than just giving it away. There's a phase out. So at $75,000 for singles, there's 6% reduction, so it actually pays out of the next $100,000. But it also, which is kind of a quirk in planning, is what I'm calling it, it doesn't actually change how Social Security is taxed. So while we think about how I was mentioning earlier, where we actually reduce taxable income, Social Security is taxed at 3 special brackets: 0%, 50%, and 85%. And if you're in that 85% bracket, you could have a quirk where every dollar over, you're actually subjecting yourself to 40% plus tax. So just because there is this deduction, we actually have to think about what's going on. There's some peculiar planning techniques involved.
Okay. Medicare-wise, let me chime in on Medicare. What is programmed in to the bill is lower payments to providers, reduction in elective procedures, and we're already hearing about impact on Medicare Advantage plans. So anyone that is on Medicare Advantage, we're already starting to hear about these things. Lower payments to providers means more out of your pocket potentially, especially on Medicare Advantage, where we're seeing co-pays, co-insurance increase. And so we're working with clients to reshop those coverages between Medicare Advantage and Medigap. And when you're talking about lower payments to providers, just so I explain myself a little bit better, there is negotiated repayments to those that accept Medicare payments. They are not allowed to bill more than that. There are other classifications, but when we're talking about the impact from this bill, I think we are going to see that. This is a time of year where we're coming into open enrollment for Medicare supplement plans, Medicare Advantage plans. And we've seen this in other various areas of other types of insurance. Coverage is declining, costs increasing. And what's the solution? We don't know, but continue to be diligent and, shop your plans, work with your advisor to shop plans to see if there's something that will give you decent coverage and, stave off some of the cost increases.
And I know this is a kind of an overarching question, but their second part was more broadly, what effect does this, in your opinion, have on the economy?
I can take that one.
Sure.
Yeah, I think, in terms of the economy, like we talked about, it's kind of that really front-loaded fiscal stimulus. So tax cuts, obviously, pushing more money into the economy. You expect that to prop up equities a little bit, kind of keep economic growth going. The problem, as we talked about, is, again, it kind of kicks the can down the road in terms of deficit. So as, some of these spending cuts kind of come into effect down the line, we're going to see the deficit rise as a result. How does that impact yields? How does that impact, inflation? Obviously, these things are kind of yet to be seen, but I think in the near term, obviously, I think it would be a lot of, economic stimulus. It's kind of the, 3 to 4 years out where we're going to have to address the deficit issue from that.
While I have you, AMD, the stock, how is this going to be affected?
So I don't follow AMD myself, but just kind of on the tech semiconductor space, there are manufacturing tax credits in this bill for semiconductor manufacturing in the United States. So I think there's benefit there. I think that will provide some tailwind. Also, when you think about some of the tech names that, we follow, some of the Magnificent Seven, in this bill, we have 100% bonus depreciation and immediate R&D expensing. So these companies that have very large R&D spend, some of the top tech companies, they're doing, cutting edge innovation, research, they're now able to front load that depreciation hit in the year that the R&D is taken. So it reduces their taxable income and lowers their tax burden. So I think just further incentivizes, like I said, R&D and also focusing on manufacturing in the United States.
Another comment, this seems to be kind of a common trend. A lot of questions on Social Security. So if there's something I missed, we'll get to those a little bit later on where you can ask yourself. How healthy is the future of the dollar and how healthy is the future of Social Security and Medicare?
You want to take the dollar?
I can take the dollar.
I'm giving all the questions here.
Yeah.
So the dollar's been under pressure, I think, for the past few months, 6 months to a year, I'd say. A big part of that is this growing deficit that we have. When borrowers look to the U.S. At their debt, as this deficit keeps rising and the responsibility of our interest payments keep rising, borrowers have to ask themselves, what is the risk of taking this investment? We saw a few months ago that I think it was S&P was the last company to downgrade the U.S. credit outlook from the top tier AAA. Obviously, it's still, I think it's AA minus. It was just one step down, but it just kind of reflects, I think, a changing sentiment of the way people look at the U.S. right now. I think before it was very much so, U.S. is the cream of the crop, the best economy, best government, the chances of the U.S. defaulting on their debt is very low. I think you look at bills like this that are projected to increase the deficit by, more than $4 trillion over the next 10 years. I think people have to ask themselves, how does that incrementally increase risk? What does that mean for yields? I think to that end, that does put downward pressure on the dollar. So it's something that we'll have to monitor. I think that the fiscal stimulus will be good, but again, it's kind of the back end of that is eventually we are going to have to address the deficit. And I think kind of pushing that down the road only puts further downward pressure on the USD. So.
Sure. To kind of piggyback off of that, there's obviously a lot of unknowns right now, internationally and domestically. A lot of questions about what the future holds. What are you doing for your clients to protect them from the unknown?
I can start with that one. You can chime in too, Dan. I can talk to kind of the strategy that we're implying, and you'll want to add to it. Is from a planning standpoint, we get very granular within each person's needs, and want to tailor that the approach, whether it's spending, whether it's investments. We want to get that tailored down to overall needs. Certainly, what we've done with clients as of recent, with markets hitting all-time highs, and we know there's cash needs and gifting, we're very aggressive in fast forwarding those things, taking advantage of elevated valuations and so on. And when it comes to cash needs, normally what we'd be looking at is what are the cash needs in the next year, maybe year and a half. And I know people are looking at how do we look out even 2 or 3 years potentially, while we have some good yields to capture in whether it's CDs, money markets, bonds of some kind, and stretch those out a bit to, again, take advantage of the elevated levels and be a little more protective, because we can't keep going, I don't know, at this pace. There's no crystal ball, but I don't know, Dan, what do you think?
Yeah, I mean, in terms of what we're doing in client portfolios, without getting too specific, we're always monitoring our exposures. So like Jason said, as markets have hit all-time highs, we've seen tech really have a really good run. And as a result, the exposure that we have in tech has increased a bit. So we're constantly monitoring our positions, and if we think that a certain position or a certain sector has gotten too much weight given the run-up in the market, we'll trim back there. I think kind of on a more granular focus, as the market has run up, we've definitely been looking at more names that are a bit more defensive, have a bit more high-quality balance sheets, just because, as the market reaches new all-time highs, there is that risk of a correction, especially now that AI has become such a big play in the market. So focusing on those, but I think just being vigilant, just kind of looking bottom-up fundamentally and making sure that we're investing in strong fundamental companies.
Just to go back to the Social Security question. So there's a lot of talk about Social Security ending, but there's an actual difference between Social Security ending and a trust. So Social Security is subsidized by a trust, which, depending on who you ask, will exhaust itself between 2032 and 2035. There's a number of ways we could fix it. When I got into the industry in 2013, it was a big deal then, and I kind of thought we would have addressed it by now, but here we are 13 years later, and it's still a big topic. But we've actually done a number of fixes before. First of all, for Medicare, it similarly had a cap. We lifted that in the early 2000s. It's 176 thereabouts. So if you make over $176,000, everything above that is no longer taxed for Social Security reasons, which is 6.2%. We can add that back in. We can also add ages back in, which we've also done before. So instead of 67, we could phase that to maybe age 70 for people who are under 50. You can means test it, which is you make over some income threshold, maybe you get a reduction in your Social Security. This would be complicated politically because a lot of people feel like they pay into Social Security, but it could be a way to extend it longer. And we can also just grow the tax base. No one ever talks about that, but more taxes means more revenue, which means that we can keep the trust going further.
Yeah, and the interesting thing there is I think in addition to those, and it's been a recognized issue for a long time, one, I just from an opinion standpoint, I think anyone over the age of 50 is probably okay. Not any major changes to the Social Security formula for above 50. Under 50, there's probably more changes on the way. But the thing that would make sense, as Andrew said, is raise the wage cap. That brings more dollars into the system. But we've recognized in this country that we have a retirement issue, and we address it at the wrong side. So with Social Security, what we've raised is the full retirement age. It's gone from 65 to 66 to 67. We've kept the top age where Social Security stops accruing is 70. The earliest is 62, and we haven't done nothing to change that. We could easily change 62 to 65, keep full retirement age of 67 and 70, and think about what that does. But as Andrew said, these aren't popular decisions. These are just opinions. And unpopular decisions like that don't get votes. So,
one last thing I just remembered.
Of course.
So we each pay 6.2. You and your employer, which is total of 12.4. If we were to bump it up 1%, Social Security would be fully funded for 75 plus years. So yes, paying a whole percentage point may not be popular. I would expect a combination of all the things we listed to actually get us the hurdle. But what I tell my clients is I'm not specifically worried about Social Security going away at this point in time.
Right. And obviously Social Security has been a common question. Just me personally curious, what has been the biggest questions you've received when the Big Beautiful Bill was passed?
We skew towards retirement age clients, or at least I do. So that the Social Security and the senior portion are especially pertinent. I would also say where I am, because property taxes are so expensive, people are interested to see if they can itemize again.
I would say Social Security it's one side or the other. There's nothing really in the middle. Is it going to be there for me?
Sure.
Or is it going to last while I'm still alive? Am I going to outlast Social Security? Those are the two big questions, I feel.
Do you have a number one question you got asked?
I'm actually on the research team. I don't have any clients, so I don't actually deal with Social Security.
No one brings it up just in general?
No,
Okay.
not for fun, no.
No. You and your friends sit around. How do you, when something like the Big Beautiful Bill comes in, how do you prepare? Because there's so much in the Big Beautiful Bill, and you have to be ready to hit the ground running when it passes. How do you prepare for something like that? Reading?
So I think it was 3,000 pages long, and you wait for someone who has the time to read the 3,000 pages and gives you a synopsis.
Okay.
I wholeheartedly agree, because the question I was getting is, are you guys going to put something out about OBA? And I said, well, we're sort of like the Apple theory in this, right? If you know Apple, the company, they didn't invent the cell phone, they just made it better.
Right.
And I'll leave it right there.
Okay, perfect. But this kind of ties in. This is a very specific one from someone in the audience. I'm an 83-year-old female. What action should I consider taking from a financial planning perspective as a result of the One Big Beautiful Bill?
Well, there's a lot to be said there. There's a number of things that income is going to matter, resident is going to matter, life expectancy is going to matter, overall goals are going to matter. If you're charity inclined, or if you want to give to kids and grandkids, that's going to sway the answer a little bit. But that does bring me to okay, let's talk about some of the things that are in the new bill for children. And by that's what we're all calling it in the industry, the new bill that passed. Everyone knows what it's called, but you can all say it easily. So the big thing that I'm excited about is the 529 expansion. So that is for education, we can say for children. We can now use it for between kindergarten and 12, up to 20,000, and they expanded what the qualified education expenses means. This could be things like lab equipment, books, but it could also be test prep, which is an expense that a lot of people are shouldering, so it expands that. But it also lets us, what am I trying to say?
There's so much. That's what we're saying. The Big Beautiful Bill's got so much in it.
It's got so much in it.
It's hard to remember.
The 20,000 up from 10, and the expanded amount, the qualified things were big things for that.
Well, kind of to add to that, and you may have answered in there, but I know we had a couple people ask about what this means for saving for education for kids' future.
So the peculiar thing that was added is the Trump accounts or Trump IRA accounts.
Yeah.
There's not a whole lot of guidance from the IRS at this point in time. What we do know is that the basis of it is an IRA, so anything that goes in will grow tax deferred, but we are limited to a year from the bill passing, so next July 2026, you can contribute up to $5,000 to it. There is no earned income requirement like there is for a traditional IRA, so typically you have to wait for your kids to have their first summer job before you can make this, or encourage them to make it on their own behalf. This you could set up, so I have a 1-year-old. I could set this up for my kid next summer if I wanted to, up to $5,000.
Okay.
There's not guidance on how we could use it past 18. So can we defer it indefinitely? Do we need to start having required distributions? Can we roll it into a Roth IRA? We're not sure yet, but we have so long before those will be answered in the time we need them.
I'm not sure if this actually ties in with the Big Beautiful Bill, but I would think so. There's been changes to student loans. How does this change college planning?
Drastically.
Okay.
There's a number of big changes. I may not knew some of them. First and foremost, we have caps, which we previously didn't have for graduate school and professional school. Previously, those didn't exist. We also have caps where parents can take out. So if you are a parent with a kid currently in college, you may be in a bind and may need to make some important financial planning decisions soon. The thing that's acquiring the debt. There's also the repayment portion. Beginning next year, everyone will be defaulted to a kind of simple plan. COVID opened up a number of different repayment plans. They are simplifying that, and everyone will be kind of shoved into plans for between 10 and 25 years. You'll have basic repayments.
Okay.
I think just adding a couple of things there, minor changes in terms of when you have a debt cancellation, usually that can be an income item on your tax return. And one thing the bill did was any discharge of student loan debt relative to disability or death, it's not includable in your income. And then you still have the education tax credits for those that qualify for those. So there are good and bad, as the caps, as Andrew mentioned as well. So.
And I know, I think we got to be coming pretty close to start taking questions, no, time-wise? I've got a few more here, but if people want to start thinking of their questions, we'll get to those in just a moment. What change, I think we touched on it real quick, but what changes around charitable givings? Are there strategies that are more appealing? What charitable giving? I think that's up to you, too.
There's a number of changes that are happening to charitable giving. Back during COVID, people got excited about the $300 they could take on the regular taxes, even though we had standard deduction. That is returning in 2026, although it is bumped up for $1,000 per person or $2,000 for a couple. So that'll hurt a lot of people who can't itemize, just be more charitably inclined than they may have been in years past. The big one is there's now a phase out for people that do itemize.
Okay.
I won't get into the nitty gritty because it's a little technical here, but it does require a little bit more planning where we want to take the charitable distribution from. Currently, we can take a portion of required minimum distributions. So after age 70 and a half, we can take up to $100,000+ and take it directly to a charity. Because it's non-taxable, this is more effective than it will be with this itemized section because of that adjustment.
Okay. What do we need to know? Is there anything that this person that wrote in can do to minimize their annual tax bill? These are all great questions.
Without looking at it, it's hard to say, but there are a number of things depending on where you are. I would look into itemizing, assuming that they're a northeast person.
Sure.
There's the charitable things potentially. If they have children, open up for 529. That's also been expanded to continuing education for people like us. So we have to take a number of hours to maintain our licenses. That is now also deductible.
Okay.
So that could be a portion. What else?
I think one that you hit on and that we're spending a lot of time planning on is the expansion in the SALT deduction, which we've talked about already. But it's bigger than just the SALT deduction itself. It's if you qualify for the expansion. See, a lot of people over the last few years were kicked out of itemizing deductions. So we were forced into a strategy that we call the lumpy deduction strategy, where you put a bunch of money, if you're charitably inclined, you donate a bunch of money or you start a donor advised fund and put a bunch of money in it in 1 year so you can get over that itemized deduction hurdle, and then you fall into the standard deduction for the next few years and you do it again and again and again. Now you can be more year-to-year planning. If you qualify for the enhanced SALT deduction, that pushes you over the standard deduction amount. You don't have to commit that kind of dollars to charity if you don't want to in that moment. So it opens up planning on a year-to-year basis versus having to look out 3 or 4 or 5 years, kind of waiting for the benefits to really reveal themselves. So I would say around reducing tax liability, just that one change has opened up itemized deductions again as a conversation, as Andrew gave some statistics, for more people than it had for the last few years.
All right, before we go, we just got a couple of last ones. We're kind of a lightning round here, a few things that we missed, and then we'll go to everybody's questions. How does this change? And you'll have to inform me on what this is. RMD.
So there is no change directly affecting with those required minimum distributions. The thing to be aware of is the current requirement is at age 73 if you were born in 1959 or before, and the next big bump is for 75. If you were born in 1960, you don't have to start emptying these accounts until you're age 75. If you were born in 1960 or after.
Okay. How will this affect state funding?
Well, I know one impact is really around Medicaid cuts.
Yeah.
And that's going to be probably the biggest impact around state funding is in that area.
And then I guess the final one here, final two, is this idea that in the media it was mentioned a lot that it's kind of it benefits the multimillionaires and not the little guy. Is that an accurate statement? Is there more to be discussed on that?
Yeah, so actually I was looking through this, and there is some estate exemption stuff for the really big guys. If you have an estate worth $30+ million, there's a nice little bump for you. But like I was saying, for my clients, so it's high earning families in high property tax states, people over 65, and wage earners, so people who get tips and overtime, all will see benefits. So no one may not be in the tens of thousands of dollars number, but they will see benefits to this.
And then finally, just before we go to the questions, is there anything that we brought up so far, or something that we didn't bring up so far that you would like to add before we take, because I don't want to miss if there's any really important topic that everybody's been sitting on until I got to it.
I think, Andrew, just one real quick, because we haven't really touched on the estate planning side of this, and Andrew just kind of touched on it real quick. We were concerned about a sunset of this major estate exclusion that we've been living with, and that has now been made permanent and even enhanced a little bit, $15 million per person starting in 2026. And then I would say a little more on the international side. We do have an excise tax. We've become, retirees seem to be more globally mobile at this point, and what we need to be careful of is an excise tax on transfers outside the country. So if you're thinking of doing that, that requires some planning as well. But we've covered quite a bit.
I'm not sure I mentioned child care credit got expanded. Was 2,000 above the 2,200.
Okay.
The 10% increase.
Great.
I think from the market side of things, to kind of tie into current events, obviously interest rates are a big topic right now, and Fed policy is a big topic right now. From a large 5,000-foot view, you look at the bill, and obviously it does support growth, very front-ended, and obviously the back end, like we talked about. It has a lot of that spending and a lot of that increase to deficit. I think tying that into current events, we have the Fed rate decision on Wednesday. We can already kind of see that this is putting them in a bit of a sticky situation. We've seen jobs data that's come out recently that has started to show cracks in the labor market, which would, incline the Fed to cut rates to kind of stimulate activity. On the flip side of that, inflation has been pretty sticky. You can attribute that to whatever you want, but I think part of that has to be attributed to tariffs. It has to be attributed to the stimulus that could cause upward price pressure. So it kind of puts the Fed in a bit of a tricky situation. I think, I think the market is expecting at least one basis cut on Wednesday. But going forward, it's going to be a dilemma for the Fed. I think if inflation remains sticky, what are they going to do if the labor market continues to show further cracks?
Right. I think we're ready to take some questions. If anybody has a question for our panel, do we have anything online?
I have one online.
Okay. Okay, for online users, if you would please use the chat. Yep, okay.
The first one online is, how do the changes affect small business owners, especially when it comes to itemized deductions?
I need to repeat that, right? Because I've got the microphone. How does this help small businesses, as specifically with itemized deduction?
Well, so Dan had mentioned a number of business-related tax cuts as a part of this. So you have, I would say probably the biggest one is the 100% depreciation deduction. That is huge for small business owners. It fast forwards what is normally an extended deduction that you take a little every year. We can pile that all into year one. And then the other one is expensing of R&D expenses. Relative to itemized deductions, there isn't much connection between those two relative to itemizing deductions, with the exception of those that are income phased out. If your primary income source is your small business and you've written your income down due to these enhanced deductions, that can then bring your personal return into modified adjusted gross income range to be able to benefit from some of these other parts of the bill.
Great. A little bit different from the big, beautiful bill, but someone writes in, what will the impact from tariffs be?
I can talk about that. Obviously, I think one of the main purposes of tariffs, or the intended purpose, is to protect U.S. interests, protect U.S. manufacturing. Obviously, I'm sure you've all heard that tariffs are generally inflationary in nature, so it's something that has to be considered. Like I just talked about, I think one of the biggest issues going forward is going to be if the labor market continues to show further cracks and inflation remains sticky. How is the Fed going to react to that? I think that there's definitely a possibility that we see tariffs show up more in prices going forward and just push prices up further. So like I said, I think that complicates the Fed's path a little bit going forward in terms of cutting rates and trying to get down to that 2% rate. But it's, as always, it's going to be a little bit wait and see game.